Karen is asking, first question here, says, given your preference for shorting high beta and momentum in quad 4, why did you decide to short the SPY instead of the Qs, given that they both traded towards the range?
Statement, I just
no, actually,
I get it. It actually it was at the top end of the range, or pretty close to it. So I'm really not discerning. Like, I think the way you asked the question is accurate. If I was just purely going to what I should do based on that factor. But there's this other thing called the market changing every day. MTUM, which is momentum, was not at the top end of the range yesterday. I don't know why. I asked Mr. Market. He'll probably let you know, or she'll let you know, whoever she or he is. So all I'm doing there is selecting the one that is closest or at the top end of the range. In the prior 2 days, it was industrials and XRT, Consumer Retail Group. So again, it's going to change, and I have a lot of things I could short. I mean, the amount of things that I could short, I mean, this is the amount of tickers that I have to short currently that I have not yet shorted.
Give me more space.
So there's a lot of stuff there. I'm not going to show you the longs. There are less of them, and a lot of them are related to housing, gold, and treasuries, extended duration bonds, zeros, et cetera. But again, the reason why I hit the button is, I mean, and I also went through it. S&P 500 has not seen an implied volatility discount of 40% yet. So to me, that was at the end, the top end of the range. I'm not going to go say, oh, but I really should do momentum because the playbook says. No, again, S&P 500, by the way, is probably a better short than other components as we go into quad 3. Don't forget that the market's starting to discount some quad 3 too, so something to think about fundamentally. In as much as quantitatively, the super short answer is what I already said. Top end of the range, finally, and massive, or the biggest implied volatility discount we've seen to date.
Yeah, absolutely, that's true. We detail this in the slide in the Q1 macro themes deck, but things like high beta, momentum, growth, tech, industrials, as we transition to quad 3, they're not explicit shorts anymore. They're not necessarily longs. You don't want to be long them, but they can do well. They're basically market performers.
Yep.
Whereas in quad 4, you definitely want to get the alpha juice on the short side of those factors.
Yep.
All right, moving on.
And even if you look at implied vol, look at the data table. There's not a better, or there are very few implied volatility discounts. Even if you're only using one thing, which I'd never tell you to do. I mean, you look at this table, and there's nothing. There are sectors we prefer to be short in certain circumstances, but there was not one thing that was better from an implied volatility discount perspective than the S&P 500. Okay, so that's it's minus 43 actually now. That's the new record. So let's go with that.
Yeah, that actually screams people are just taking up their GMV, their gross margin, their funds. Yeah, we're re-levering. We're back in it to win it.
Yeah, you want to know how that works in the hedge fund business, given that I had a successful run there. Yeah. And even if I didn't, at least, unlike most people you hear on TV who've never run a hedge fund, never mind a good one, they know everything, right? Right. Joey at Bloomberg, you know everything. Never traded a market in your life. That's really good. That's awesome. That's so cool. It's awesome. But here's how it works, okay? Especially given that 80% or more of non-quantitatively oriented hedge funds run naturally long with big gross exposure and big nets, positive nets. Okay, it's infrequent it's just infrequent that you have people running net short hedge funds. Okay, people are good at it. That's primarily why they don't do it. And most hedge funds are just people that were long onlys that are now levered long. So again, understand that when the market's going down, if you think of, let's just use a basic hedge, okay? Let's use what a lot of them do because they're not good at short selling. They wouldn't pick a collective basket of stocks like we had Constellation Brands on yesterday at Hedgeye. So again, that's been a great short for us. That's institutional research, best idea short from Howard Penny. So as opposed to doing that, a lot of hedge funds, let's say that you're running 200% long. Say your long book you're running plus 200%, okay? Your longs, that's your long exposure. And then you have you want to be 100% long, just like a long.
Jeez.
All right? So your shorts are 100%.
100%.
So that makes you net 100%, plus 100%, 200 minus 100.
Yep. So your GMV's 3.
Oh, damn it, Keith, the market crashed. I can't do this anymore. I'm supposed to be a hedge fund. So after the move, what I do is I take this short exposure to 160%. So now I'm only 40% exposed to the market. I'm going to use a basic example.
But the GMV is higher.
As soon as the market goes up, oh my God, I got to go back to being who I am, which is really a levered long only, and I got to be here. So that's why you see the implied vol discount develop. People are constantly going back to the only place they feel comfortable, and if they don't make money when the market's going up, their investors will fire them. Okay, so there's a tremendous amount of pressure in the 1 week, 2 week, 3 week, 4 week window because most hedge funds that got smoked in the fourth quarter will go away in the first quarter if they screw it up again. Okay, so be careful in understanding that there's so many different things that are at work here that are driving these implied vol moves. And they're driving them in a very short-term window, which we've tried to teach you for the last 3 years. It's become readily apparent to anybody that's using the data as opposed to some journalistic view of what the market is actually doing.